Hello, everybody, and thank you for joining this special webinar today. Let me just double check with FX Street that we can actually hear me. I'm hoping that you can all hear now and that my mic is working. If I could just hear from, it seems like it's okay right now. Just bear with me one moment just while I put up my piece, and then we'll go from there. Just bear with me one moment, guys. I'm just going to have to turn off just a couple of things here and then get going again. Great. Right. From the beginning. Cool. Great. So it seems like all the sound is good. Thanks very much for joining. I know this is a special webinar on trading news events. So I hope you just had a good session beforehand, and we'll get on and try and see how this one goes. Now, this is the title of mine is called How to Avoid the Pitfalls of Trading Economic News. And the reason why I do that, I would consider myself very much kind of a fundamental trader. I like trading around economic news, but there is a great amount of risk around it. I think some people, when they first start trading anyway, or first start trading economic news, think they can just think it's simple, think it's very easy, think they know the direction the market will go in. Well, actually, you know, by and large, the market can do the strangest things around economic data. So I'm going to go through some examples with you today, just to try and get you to understand really what that's all about. So let's get through this. Now I'm just going to check something and see if you can follow. So that's just our disclosures there. Don't worry too much about that. Now I'm just checking if FX Street can just let me know whether or not I can, whether or not they can see my slide, which is why trade news. Slide is fine. Great. That's good news. So why do we trade the news? Well, you may have heard this from the other guy, but I'm giving you my take here. It's often a popular time to trade the markets, and you know, remember, even those of you who trade, you know, who are big technical fans, remember the biggest reason why, you know, you trade technical analysis, and the main thing that you're always looking for is, you know, where is the trend? Where is the market in this? You know, where is the crowd? That's kind of always the thing that you're looking for in technical when you're using technical analysis. Well, interestingly enough, that's kind of similar, but here we just happen to be using a fundamental event. But it's a great crossover with kind of technical fundamental analysis. You obviously, the main reason why we all do it is to try and make money. And traditionally, I think the market sees big events like this, like some economic data, as a great time to make money in the FX market, because you get things like big market moves. It's very good for trade setups, which I'm going to walk you through. And of course, volatility. Now, volatility can be a bit of a double-edged sword, but it works. So how do you trade the news? Well, you know, you've got to decide what economic data you want to trade. And I'm going to give you some tips on how to do that in the coming slides. You then pick your strategy. Again, I'm going to give you some various strategies. And then you devise your setup. And that's really, really important. What's great about trading economic news, I think, is that you know when to trade. I sometimes feel like when you trade maybe just technically or just off your charts, yes, you know, you can be looking at charts all day. You can have your you know, buy and sell levels, but you know, something can happen that means that you're not actually able to execute that trade. Maybe your alert doesn't go off. Maybe you had to leave your desk, or you lost your smartphone on the train or something. Whereas sometimes I think with fundamental trading around economic news, especially economic data, less so headline risk, which we'll come into in a minute, really does mean that you have a time to trade. You know, there's a good basis for doing it. You're kind of rooted in it. Okay, so what should you trade? Well, you know, the economic data that tends to, and I'll show you some evidence for this in a moment. But the economic, you know, you want to trade economic data that causes big moves, that causes volatility, that gives you the opportunity to make money. And to do that, this is a list. It's not a comprehensive list by any means, but it is a list of things that can, or the big economic news that I think generate the most excitement, the most volatility around the market. So, for example, non-farm payrolls, the FOMC, so the US Central Bank, US retail sales, US CPI, European government bond auctions, especially recently, global PMI data. Now, these are just some of the things, but there's some of the economic data releases. There are plenty more, and please, I'm sure that people will give you great reasons to trade other things, but I'm not here to do a comprehensive list. I'm here just to kind of tell you, a few bits about why this economic data is good to do. So someone just said no interest rates. Well, of course, interest rates as well, but actually sometimes a lot of these events can really impact interest rates. So that's more of a derivative. But actually trading on the back of interest rates isn't really a news event, and that's more like a market move or a technical move. And so I'm going to focus on these, but obviously European government bond auctions, interest rates are very important there, as are interest rates, especially European ones, now around the time of during the sovereign debt crisis, which I'll go on to in a minute. Okay, so economic data does tend to be US focused. Yes, the world is bigger than the US, for sure, we know that. But the US is still the biggest economy. It's still got an incredibly important economy. It's still, it's still absolutely central. It's the world's biggest economy still. It's also the world's reserve. The dollar is also the world's reserve currency. So in that sense, this is, US data has a huge impact on the markets, not just on, the dollar, but on other asset classes, on risky assets, on interest rates in the US, on dollar yen. All of these things really can kind of impact it. So, I'm saying, for newbie traders, so for those of you who are either new to trading or maybe haven't traded fundamental data before, pick major events that the world look at, like that list that I gave you before. So like that non-farm payrolls, FOMC, retail sales, CPI, government bond auctions, global PMI. That's kind of the best thing, especially if you're kind of new to it. Start with the big liquid events, the big events that everyone's looking at that will probably cause some sort of volatility in the market. Now, for more advanced traders, which I don't really go into great detail here, but foreign economic data is absolutely fantastic. If you're trading, the Aussie in London time, then maybe you want to be looking at the Chinese economic data. Maybe you want to be looking at, Scandinavian economic data if you're trading, obviously if you're going to trade the Noki. Oh, apologies, just one moment. I don't know what I've done there. Apologies. I'm just going to have to pull up my slide again. Here we go. Apologies for that. For more advanced traders, as I said, foreign economic data. If you're trading the Noki or the Stocky, you want to be looking at Norwegian economic data. You want to be looking at what the Norwegian Central Bank is doing. So there are plenty of opportunities, and because it's a 24-hour FX market, there are so many opportunities to trade economic data. Okay. Now, the big movers in recent weeks. So what I decided to do was, it's all well and good me saying to you, yes, the market moves on the back of NFP, on the back of retail sales. But, I actually thought it was more realistic of me to look back at these announcements over the past month and try and give you an idea of how far the market moved in the preceding 2 to 3 hours. So not long-term moves. These are kind of, shortish type of moves for the short-term intraday trader. So within kind of 3 hours of the event happening, the NFP in the US at the beginning of June, and this is, by the way, over the past month. So, for example, NFP is May's data that came out the 1st of June. So after that release on the 1st of June, the NFP caused the dollar index, so I looked at the dollar on a broad-based basis, to move 90 pips. So the dollar really, the dollar had a huge move after that massive miss on the NFP. Now, retail sales we had yesterday, much less of an impact, about 20 pips. The Eurozone PMI, now I'm looking at euro dollar for that, 50 pip move. That's a big move, right? And that came in again at I think it was the 5th of June, and I didn't use the PMI, the manufacturing PMI, because that was released the same day as the NFP. And the NFP, if you have other data releases on the same day as the NFP, really, the NFP is the big beast. It's going to win out here. So I chose to look at the composite PMI, which was released on the 1st of June. It was a second reading, and it did cause a move of 50 pips. It was slightly better than expected, so it caused euro-dollar to increase, or euro-dollar to rise 50 pips that day. Now, the ECB meeting, again, which was the first week of June, and that was when Draghi was less dovish than expected, didn't announce any new policy measures, caused 80 pip movement. The FOMC back in April, which was their last meeting, interestingly enough, the FOMC hasn't had as big a movement as the ECB. Well, there's a good reason for that, I believe, because the FOMC is very much being directed by what's going on in the ECB. Likewise, US GDP for Q1, and that second revision was actually weaker than expected, so that did cause a bit of a move in the market and an 80 pip move. So again, there's a few things that are coming out here now. Number one, pick your data. What are the big beasts? What really moves the market? So you can see here it's NFP, ECB, US GDP. The second thing, the reason why US GDP I wouldn't naturally put in that list, the reason why I did is that it missed expectations. So that shows you another lesson to be learned. Expectations are really key in this business. But overall, the most volatile would be NFP, PMI, ECB, certainly in the last past month. So these are some tips for trading the news. Before we can go into trading setups and what strategy you need to use, you need to do your homework. So you need to get an economic calendar or look at an economic calendar. You need to choose your data. You need to know when it will be released. You need to you can get them in newspapers as well. And sometimes they'll provide you with the market consensus, so what the market expects. The other tip that I would give you for this, when trading the economic news, especially if you're trading kind of the main things like the NFP, only trade the major currencies when you're doing this. Don't do a weird euro huff trade, or maybe a strange, or an exotic, some sort of exotic currency. And the reason why I say that is that they're just not as liquid. FX Street also have a great economic calendar. Brilliant. So you can look at them there as well. Only trade, but going back to what I was saying, only trade the most liquid currencies. So we're talking euro dollar, we're talking cable, we're talking dollar yen, dollar Swissy, dollar CAD, Aussie dollar. They would be your main ones, and you can do some of those crosses as well. But you've got to be trading your 8 majors here. Because again, as I said, the market moves so quickly, you want the most liquid currencies. If you have a very illiquid currency, you could get blown out of the water if you put your trade on the wrong way. Trading on headlines. Now this too has become a massive event, and a massive market mover in recent weeks and months. So we've seen the Eurozone debt crisis. It's fueled headline risk for the market. So for the last couple of years, actually, the Eurozone's been at the beginning of things. We see it all the time. It could be what politicians are saying. Merkel was talking this morning. People are going to be not just wondering what she's wearing and whether or not that coincides with the German football team during the European Championships, which was a headline in the news this morning, by the way. It's going to be about EU summits, emergency ones particularly. Sovereign credit downgrades like we got last night. That's going to have an impact on the market. Emergency phone calls, such as what we got over the weekend that led to the 100 billion Spanish bank bailout. So it's never really a dull moment. Not only is it these economic data releases that are kind of set in stone and they happen, every month with regularity, but it's also, headline risk, a stray headline can cross the market, or it could be a political event. Political risk has really come into this. When I was asked to do this, and it's such a great thing, I was like, you know what, a really good one to do is almost learning the lessons from the Eurozone crisis, how to trade political risk, or how, in some cases, how to survive political risk. Right. So, for example, I'm just showing you some examples of what has happened after the Spanish bailout. So we got that announcement over the weekend. Obviously, the FX market was closed. By the time Tokyo opened, as you can see here, a huge gap higher. So these event risks, not just economic data, but also event risks, can have a massive impact on the market. Very difficult to trade, mind you, but we'll go into strategies in a moment. Again, likewise, the Aussie dollar also had something. So it's not just because there was a bailout in Europe, didn't necessarily mean that there was just going to be a knock-on effect on the Aussie. for example. There could have been, many other effects across other currencies, and indeed, the Eurozone debt crisis is really dominating market sentiment at the moment, and so it had a knock-on effect on the Aussie dollar as well. So as you can see, gap higher there. Now, there are some dangers and pitfalls of trading the news. Volatility is both a blessing and a curse. Sometimes economic data, let's go back to economic data now, that I just put that kind of headline risk in there as just an aside and something to remember. Whipsaw price action. For sure it can cause whipsaw price action. Let's just go back one moment to the euro dollar. So as you can see, euro dollar had that huge gap higher after the bailout. We then saw it spike all the way back to 126.50. People are like, hang on a minute, this bailout is not solving on the crisis. Caused it to fall, then caused it a bit of a recovery. So a lot of whipsaw price action in a fairly short period of time. The market also doesn't always move as you expect. Now, this is just a very kind of blown up, kind of shortish daily chart of a shortish time frame, just one day of the 1st of June when we got that NFP report. So the NFP report was much weaker than expected. There have been some signs that it was going to be weaker than expected. So we actually saw the market kind of rally, kind of range trade really into it. And what you can usually see is that when the market range trades into a data release, if that range tightens in any meaningful way, then you can pretty much guarantee that there's going to be an explosive reaction to the economic data or an explosive reaction to the news. And indeed there was. I mean, look at that. That's like kind of 4 times the size of the range preceding the data release. Both kind of down and up. So we kind of fell, jolted back up, and then actually closed lower on the day and carried on a bit of a downtrend throughout that afternoon. So you had kind of, a couple of hours there where things were very, very volatile in the market. So that was on the 1st of June. So let's have a look at a case study because, it's all well and good me telling you what happened, but let's try and work it through ourselves. So, for example, now I'm not using any particular, I'm using kind of my own experience from trading NFPs. So the market is expecting 200K, an NFP, a very big number, especially in the current environment, but the number comes in at 70. So that's a big disappointment. Would that necessarily be dollar negative? You would think, right? So the US economy is not creating jobs. It could lead to more QE from the Federal Reserve to try and boost the economy. QE tends to be dollar negative. I think that is dollar negative. However, what we've seen beforehand, this is when I say you really need to be doing your homework, especially for things like NFPs, because a lot of things, there are a few different releases regarding kind of unemployment and labour market report throughout the month. So one of those is, for example, initial jobless claims. So on a weekly basis, the US measures how many people are signing up on the dole. And they had been trending negatively. Say, for example, they had been trending negatively combined with maybe a weak ADP report, which measures private sector job growth. Hence, it's not going to be weird to see that number coming in at 70K. So again, big disappointment, dollar negative. But how did the market react? Well, 30 minutes before the event, a lot of people expected maybe a weaker number. So they started selling it off before we actually got the number. So it's this kind of sell the rumor, buy the fact. So they sold the rumor. So they did kind of, the big movement happened. The expected movement of a weaker dollar on the back of weaker data happened actually before we got confirmation. And that's because the market's just priced things in very, very quickly. So what we saw instead was that once the result was announced, the dollar actually started to rally and give back. So it did exactly the opposite of what you expected. But however, it ended up closing the day where it started. So let's just go back. Bear with me one moment. I'm giving you a sneak peek. Let's go back to here. So using this as an example, NFP day. Market's trading in a bit of a range. They haven't sold off or done anything. We then get that kind of negative surprise in the NFP data, which then causes a bit of volatility in the market. Actually, this time, the market's actually closed lower. But again, we didn't just close on the back of that much weaker. We didn't just kind of have these huge moves throughout the day. The market did settle down. So that tends to be the move. That tends to be kind of what happens as well. That you get kind of tighter range, then very large, then big bout of volatility, then kind of the range tightens back down again, as you would expect into the close. So how do you trade this situation? Well, there's two ways. The first is with a directional bias. So you think the number's going to be weak. So a directional bias is when you're saying, right, I think the number's going to be weak. I'm going to sell the dollar. That's my view. My direction is, my bias is that I think the dollar's going to be lower on the back of this. So you kind of go with your fundamental analysis, kind of almost regardless of what the charts are telling you. You think the number's going to be weak. Do you go and sell the dollar when the number comes out? Now, one thing I would argue, make sure you have a wide stop. Because as I said, sometimes the market doesn't go the way you think it should. A directional bias does tend to suit a longer term time frame. Again, as I said, the key thing here is that you need to have a wide stop. There is another way. You don't always have to kind of pick the direction of the market and try and get it right. You can have a non-directional bias. Now, this is where you don't even take a view on which direction the market's going. You just try to position yourself to ride the movement whichever way it is, if it's up or down, and which is a straddle strategy. So when you have a non-directional bias, you're really using a straddle strategy. Now, some people think straddles are very complicated. There's some kind of exotic trading strategy. They tend to be more akin with options, and that is true. However, they're very, very simple. They are not difficult to work out, and you can do it you can almost create your own synthetic type of option which I will show you how to do now. Sorry about that. So, for example, let's take a look at your directional bias. So this is your first trading strategy whereby you're taking a view. And you've taken a view that the NFP is going to be weak. You've done your homework. You're sitting there going, there's no way the US economy is going to do as well. Look at the initial jobless claims. Look at what the ADP did. Look at the weakening in other jobs growth, such as retail sales and maybe some corporate results. And I hear that Apple are laying off loads of people. Now, that really would be a disaster, wouldn't it? They're not, by the way, but that's just as a hypothetical situation. So you've done your homework. You've got kind of three pieces of evidence to back up your expectation that the payrolls number is going to be weak. I think that sounds fair enough. Dollar, you're also looking at the charts, because remember, those of you who kind of trade in a similar way that I do, you'll look at fundamentals, but you'll also be looking at the charts as well, because remember, the charts give you your buy and sell and entry and exit levels on a plate. Now, you don't want to be missing them out. So the dollar's already had a big move versus the euro, as you can see. This goes, but we're looking at kind of the NFP release on the 1st of June here. So looking at, the high here that we saw the 21st of May, within kind of 2 weeks, we've seen a 4% drop in the euro, a 4% rise in the dollar. That is a very, very big move, and it's been pretty much unrelenting. Thus, if we get kind of a fundamental, something that's fundamentally weak for the US dollar, that could be the something that causes the dollar to start to weaken. So hence we are looking at we're thinking, okay, fine, there's a technical basis and a fundamental basis to go negative or go short the dollar. So basically, what we're kind of putting down in our heads is this: we're putting our tick box down. So for the NFP, the 1st of June, 123.50 looks extremely oversold. I do realize that in the other chart you didn't have a price tag, but trust me, that's where it was. 123.50 in euro dollar looks extremely oversold. A weak payrolls number could fuel more QE speculation and weaken the dollar. Again, as I said, you believe the NFP will be weak. You've done your homework. Again, those kind of three things that I suggested to kind of back up use as evidence to back up your fundamental view. I haven't been to Athens. I haven't been to Greece. I haven't taken a poll myself. I don't really know the temperature of the market out there. I know what I see in the papers, but do I always believe that? No. Hence, added to that, there's also no pre-election polls in the 2 weeks leading up to the election, and I don't really know which way it's going to go. I'm hearing things about radical left parties. I'm hearing things about New Democracy, whether they're pro-bailout, anti-bailout. But I really don't know which way they're going to go. So thus, for me, a non-directional bias is going to work. I just know that this is going to be a big event that the market is going to look at. I know that it's going to cause volatility. I believe it's going to cause volatility. I believe it's going to cause a big market move. I'm not 100% sure which way the market's going to go, so I'm going to go with whichever way the market ends up settling on. And this is how I would set that trade up. Number one, you've got to determine your range. So determine the range, so that will give you your entry and exit levels. as I said, these numbers then become your buy and sell orders and can also act as your stop loss. Step 3, you wait for the event. However, this time you're waiting for the event. You've got a clear strategy in mind. You know your buy and sell levels. Actually, it can be quite a relaxing experience. So, for example, here, you've got a non-directional bias euro-dollar trade. Your buy order is at the top of the range. This is euro-dollar, sorry. So, as you can see, going back to, this is post-bailout, as you can see. That's the big gap higher. But since then, we're looking at it really from then, really, over the past week. The top of the range has been this kind of 126. That's acted as really good resistance. The bottom of the range, 124.50. We've really been stuck in the middle of it for most of today, for most of this week. I would argue then that the top of the range is 126.20, the bottom of the range 124.50. If we get a positive result, so if the market thinks that the Greek election comes out in a positive way, then we could potentially, surge higher above 126.20. Thus, 126.20 may be a good entry level. However, if it's negative, if we maybe get one of the Syriza parties or the radical parties who are very anti-bailout win the election, that would up the chances of Greece actually leaving the Eurozone, and then maybe we'd have a good sell order at 124.50. Now, just going back one moment, this is essentially your trading strategy. So what you would do, you would place a buy order here. Oh, my apologies. You place your buy order at 126.20, just in case you actually just in case it's good news. Set your sell order at 124.50. Now, let's say hypothetically that Greece has a negative reaction. What we've seen what we may see is that there's a bit of confusion about what's going on. We see the market spike a little bit. It goes above 126.20. Now, you do get fills at 126.20. However, all of a sudden, sentiment shifts. We get there. We realise that actually no, the pro-bailout party hasn't made it. We've got the anti-bailout party. Oh goodness, Greece looks like it's going to leave the Eurozone. This is going to be really negative for the Euro. If you'd had a directional bias and only thought that you're going to get a good result, you'd be out in a moment, because all of a sudden you'd see Euro nosedive back from kind of, you've got in here. Yes, it may have spiked up here. It may have even got to 126.50. But then you get the other bit of news that says that actually, no, the result isn't what you want. It nosedives down. It could easily get through 124.50. Well, that's what you're hoping anyway. And then you would be selling here anyway. So you would miss some of the moves for sure, but you would have protected yourself, because you're assuming that actually the move could be much longer, could last much longer, that you've got kind of almost like unlimited downside with limited upside. So by getting in at 124.50, or say 124.30 maybe, you really are kind of you are losing some upside, or you're certainly you'll have, rather than getting a better level at 126.20, you'll have got in at 124.50. If you're nimble, then you may have got in a little bit before then. But because of the way that the market's going, you would potentially say that below 124.50, that's the start of a new trend. So you're actually getting on at the new trend. You're being very disciplined. I would recommend that you don't start fiddling with your orders while the market action is happening. You open yourself up to a lot of kind of risk there, and you don't really want to be greedy. You want to be smart. And by doing this, by identifying your range, by placing your buy order at the top, your sell order at the bottom, you're being disciplined. Yes, you're not necessarily getting every single pip of the move, but you know where you stand, you know where you think the breakouts are, and so that's you're trading them. You're not kind of wasting your time. Okay. There are pitfalls, as I said. That this was the title of my webinar, and it's it is the way it is. There are certainly pitfalls of trading the news. For those of you who are doing this, you can do it. Someone's just said a really interesting question. Why not sell at the top and buy at the bottom? Well, you can do that, of course. That would be your ideal. But sometimes you don't necessarily think that, because what if the result is good? What if the economic data is good? For example, for the political news, you could potentially see a lot of kind of weakness around here. It's really about, getting a strategy that helps you react to the news event, so to the actual concrete event as it comes out. So, for example, you could be waiting to get in always at a better level, but you may miss that boat, and that's what you don't want to do. You don't want to miss that boat. So, for example, if we were having just a directional trade here, you may, you may have then seen that, oh, hang on a minute, we've got some, negative news coming out of Greece, what's going on? Well, all of a sudden, we might have actually been priced in already a bit of negative news. So it may mean that actually what we'd see is the market start to rally a little bit. So if you've got that kind of environment and then you see the news turn and you get in at 126.20, fantastic. However, what you don't want to do is kind of get in at around kind of 126.20. The market then goes back to 125.50, doesn't really do anything, and you're stuck in this kind of range trading bid. Now you'll make a bit of profit, but you won't make as much. Really, what we're saying here by identifying our ranges is that 124.50 is really where the market will, where we believe the market starts kind of a new paradigm and we may head back down to 120. So this is again a longer term strategy here. However, you can make it more shorter term. For example, you could say, well, my medium term range is going to be kind of 126.20 on the upside because that's such an important resistance level, but 125.50 on the downside. So you may say, well, if it falls below 125.50, you're then going to kind of sell it. To be honest, what you'll need to do is check your range about 30 minutes before the event. So then you determine your range and you also determine your time frame. If you're longer time frame, you may want a wider range. If you're shorter time frame, narrow it down. But again, what we would expect is a very large move on the back of this. So you can actually kind of do both or adjust it as and well you see fit. And what's always good, as I said, of course you can sell at the top. Of course you want to sell high and buy low. With economic events, the market moves so quickly. You could see kind of whipsaw action. You could see easily 200 pip move in a matter of hours. So it's very difficult to do what you just said, selling at the top and buying at the low. It's better to have, I think, your sell and buy orders in already, so that you get triggered based on the event. Because otherwise you see massive whipsaw and you just may not be quick enough on your button. What if your screen freezes, which I'm now going to talk about actually. So pitfalls of trading. This is kind of might answer your question as well. Why do spreads tend to occur during periods of volatility? So you want to put your orders in now, so you know where you potentially are going to get filled. Slippage can happen, for sure, right? So you put your order in. The market is hugely volatile. Some provider, markets can be, crazy around periods of volatility like this, and that's how it's different to trading normal reaction. So in a normal, if you're just trading based on kind of a trend that you're seeing in the market that's kind of taking place over a number of hours or days, then of course always sell high and buy low. But sometimes with market data, you've got to be a bit smarter then. So what you can sometimes get wider spreads of volatility, and the reason why is that the market's moving so quickly. There's tons of sell orders, there's tons of buy orders, and that causes the system to, as I said, to widen. Now, there's many reasons why that can happen. I can't list them all here today because sometimes you just don't know. But they can certainly widen during periods of volatility. But again, it's largely to do with kind of huge amounts of volume actually pushing that spread wider because you're getting tons and tons of bids and buy and sell orders at very, very different prices. So when you average them out, the spread just gets much wider. Slippage can happen, as I said, again, because of the sheer volume of deals going through. You may not get filled at the price that you wanted. However, for example, with us at Forex.com, you can state your tolerance levels. You can say, well, for example, I want to get in, I want to, sell. I'm going to buy at 126.25, and however, I'll give you a range of, I'll allow you to go 15 pips higher than that, maybe to 126.40, but that's it. After that, I don't want to. It's kind of messed me around. So you can adjust tolerances levels, so you can try and limit your slippage. Do investigate with your provider to get more details about that. Again, screens can freeze. Power cuts can happen. So when you're kind of there trying to react immediately to it, what happens if, you pull the plug out by mistake, or what happens if you kind of screens freeze or your platform freezes? That's why it's good to kind of have your strategy in place, maybe have your orders in place already, so that you're just kind of out of that. Now, obviously, if screens freeze and power cuts, make sure that you get onto your provider immediately, because you always want to know where you are. But it can ruin your economic news data and can cause you to have a loss. Very difficult to know which direction the markets can move prior to the event, and that's one of the risks you're taking. So you take these risks when you trade economic data, but then, the benefits are that you can get a very big move. You can also get a lot of volatility in the market. So some golden rules for trading economic data, and I've kind of moved it or changed it to, or split it out between directional trading and non-directional trading. So for directional trading, know your data, know it inside out. Do your research, do your homework, make sure you know the overall trend of the data so you can make an informed decision on which direction you think the market will go post the release of the data. So as we said, if you believe that, the US labor market isn't as strong as maybe some people suggest and you'd want to go short the dollar, make sure you have evidence to back that up. And make sure you know what the market expects, because as I said, the way that the market reacts is based upon the market data and where it fell relative to expectations. Take a look at the charts 30 minutes before, just so you know what's going on. Even if you are sure that the dollar's going to sell off on the back of this, and that's your kind of fundamental view, just still look at the charts, just in case something funny is going on, just in case, just so you know what's going on in the technical picture, in the price picture. You then place your trade and make sure you use a stop in case of whips or action that goes the other way. And as I said, sometimes the markets can move the other way because they price in first. But, also make sure you have a wide enough stop to be able to cushion those blows. And also, as I said, direction trading can sometimes be quite long term. Golden rules for trading, for non-directional trading. So non-directional trading whereby you don't care which way the market's going. You just want to ride that wave. So it's a good strategy to trade data and get on the back of big moves, especially if you're a more technical-minded person. Sometimes, I work with a guy who's very technical. He doesn't really like fundamental. It doesn't really excite him. He doesn't really get that into it. But, if you have a non-directional trading strategy, then you can combine your passion for technical analysis with an economic event and not necessarily have to miss out on those kind of big movements. So just because you're a technician and you don't look at fundamentals at all does not mean that you can't trade fundamental data. It's also great for trading kind of headline risk and other news and political events. You must look at the charts and make sure you have a good charting package, it's up to date, you pay the subscription and whatever else, because you have to determine your range kind of in the half an hour, maybe 20 minutes leading up to that data event. You then place your buy and sell orders, again, as I said, like your straddle, about 20 to 25 pips away from the range you've determined. Again, so 126 seems to be the high in euro dollar. I put my kind of, buy order around kind of 126.25, just in case, we kind of spike up and then head down again. Although you will likely lose on one side of the trade, you should cover your losses on the other leg of the trade, okay? What's so great about non-directional trading is that it removes emotions. Your strategy, you don't have to just kind of go on your gut with all your kind of fears and worries and everything else. It removes emotions. You're saying, I don't really care which way it moves. It doesn't matter to me. I'm just trying to make sure that I move both. Now that does cost you something in pips, in case the market whipsaws one way, puts you in, and then whipsaws the other. But you should be able to manage that fairly well. Okay. So I've had a couple of questions which I'm going to answer. This is the end of my presentation, actually. I've run over my time, so I do apologise. Bear with me one moment. I'll just... I just, again, like to thank you all for joining and for FX Street for hosting me. But someone's just said, how do you know how big institutions trade with economic data, news, and headlines? Well, they trade on both. They'll trade sometimes based on non-directional, they trade directional. But this is a strategy that can be used, but these strategies can be used for both the giant guy, so the big guy, the big hedge fund, the big institutional investor, as well as, the small retail player as well. It's very similar. It's a very similar thought process. Is it normal for price action to go the opposite of what expected? Unfortunately, yes, it can be. As I said, people will price things in, and they can price things in massively as we lead up. The market does tend to kind of price things in and get ahead of the gun. So that's, you kind of buy the rumor, sell the fact. That's where kind of that came from. And that is very alive and well in the market. So again, as I said, make sure that you have wide enough stops if you've got a directional trade on. Spanish 10-year yields went over 7%. Wouldn't you expect Eurodollar to go down a lot? Does technicals or other fundamental news matter today? Really interesting question. I've actually been looking at that a lot with some of kind of colleagues here. And really interestingly enough, yes, Spanish 10-year yields reach euro high. Bond yields seem to be pricing in much more panic than the FX market does. What tends to happen is that the bond market may move first. FX market will move secondary to that. Added to that, we've also seen added to that, we've also seen the range between euro-dollar today really, really narrow. At one point, it was about 40 pips, which is really narrow relative to kind of the previous ranges in previous days, which had been around 100 pips. And usually when you see ranges really narrow like that, it means that come a kind of trigger event, be that, you know, Spanish bond yields continue to rise, or maybe the outcome of the Greek election, and you then get this kind of explosive reaction in the market. So markets moving either one way or the other. So maybe it could move to the upside for euro if the ECB comes in and starts buying bonds, or you know, there's euro bonds all of a sudden in the eurozone. Likewise, on the other side, you could see the complete opposite if we get a negative result out of that Greek election, and maybe Spanish bond yields keep moving higher. So fundamentals and technicals, they kind of do matter today, but they matter in a different way. We're seeing the range narrow, and when range is narrow, expect a big movement on one side or the other. So again, kind of a straddle strategy may work. Equally, you may want to wait for kind of a more directional bias if that suits you. Okay, everyone, I'm happy to take kind of one more question because I have run over, and I know there's somebody else, I'm sure, waiting to go in. But it's been really great to be on this. Thank you for joining, everybody. There's a good crowd here, and I appreciate you guys taking the time to do this. Also, thank you, you know, FX Street for inviting me to do this as well. So, you know, do let me know. I have got another webinar tomorrow, the London FX Open Breakfast at 8 a.m. London time tomorrow. Please do join, and I hope you guys all found this useful, and that maybe it gives you a few tips for trading economic data in the future, trading economic news, maybe even trading on the back of this of this Greek election. But overall, brilliant. The webinar was recorded and will be available on the FX Street website. So again, don't forget that FX Street calendar as well. Okay, everyone, thanks so much, and I hope to join you soon. Bye bye.